the cost incurred, actually cost incurred by any business to raise the finance or capital. Which are the four items are? One is equity share capital, number two preference share capital, number three debenture, number four retained earning. So cost of equity, how to calculate? First is dividend divided by market price of the share into 100 plus growth rate. Hello my dear students, I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to have Advanced Corporate Financial Management belongings to 5th semester Unit 1, Session 1 in favor of BBA. So the subject name goes Advanced Corporate Financial Management belongs to BBA 5th semester Unit 1, Session 1. I am going to hand on cost of capital, the first chapter. I am going to explain what do you mean by cost of capital, what do you mean by weighted average cost, and then I will go to problem. Agenda: cost of capital, weighted average cost. Today I am going to discuss one is cost of capital, second one weighted average cost of capital, number three problems and solution on weighted average cost of capital. First I have to explain what do you mean by cost of capital. It is the cost incurred by any business to raise the finance or capital. It measures the cost of any specific source of finance. It measures any specific source of finance. It is also the minimum rate of return should be earned on the whatever the investment made. You have to earn a minimum return, maybe 10%. So everybody will accept about some percentage on the investment. That is the cost of capital. It is the cost incurred, actually cost incurred by any business to raise the finance or capital. It measures the whatever the cost of capital, it measures the cost of any specific source of finance. It is also the minimum rate. It is also this minimum rate of return should be earned. It should be earned on a, you may say that the minimum amount to be earned is 10% on the investment. That is your cost of capital. Then come back to this word, weighted average cost of capital. Problem will be asked on this basis. It is the overall cost of the capital of the firm. It is the overall cost of capital of the firm. It is also called cut-off rate. It is the minimum rate of return that any business should be earned to avoid losses. It is calculated using weights or proportion of various sources. Which are the sources of finance, especially for a company? One is funds. We say the source is the fund. Which are the funds are? One is equity share capital. One is preference share capital. One is a debenture, it's a long-term loan, and the retained earning. Which are the four items are? One is equity share capital, number two preference share capital, number three debenture, number four retained earning. This is the various source. And the respective specific cost, this you have to specific cost to be calculated of the firm. First, we have to find out the weight, add all the source, and find. I will say how it will be. How it will be calculated. So this is a problem they gave. What are the sources they have given? Equity share, 10,000 shares, 100 each, 8% debenture, 10% is all the source. So while you are doing the weights, how to do the weights now? 10,000 divided by 60,000, 30,000 divided by 60,000, 20,000 divided by 60,000, that's the weights. How it is a procedure? The total amount available is 60 lakh, 10 lakh divided by 60 lakh, 30 lakh divided by 60 lakh, 20 lakh divided by 60 lakh. That is the first step to do. Second, equity share can be sold at rupees 150. Then we have to find out the cost of capital. It can be calculated with the help of the formula dividend divided by market price of the share into 100 plus growth rate. What's the formula? Dividend divided by market price of the share into 100 into growth rate. Then whatever the percentage preference share, the same percentage has to be retained. This is our cost of capital. Regarding the debenture, cost of debt is I into 1 minus T. Tax should be deducted. What's the formula? I into 1 minus T. So this is going to be applied now. Equity share can be sold at rupees 150 per share. This is a market price. It is anticipated the company will pay a dividend of rupees 12 rupees per share, which will go at 8% for our assume that 30% tax rate. You are required compute exiting capital structure. First, calculation of WACC means weighted average cost of capital is based on existing capital structure. So calculation, what's the formula I told you? Dividend divided by market price of the share into 100 plus growth rate of the share. What's your dividend? 12 rupees. Market price of the share is 150 into 100, 8%. It was KE means cost of capital workout 16%. Then cost of preference share capital given 10%, that should be worked out. Cost of debenture KD, I into 1 minus T. Your rate of interest is 8, I means interest. 1 minus point means 0.70 into 8, it comes to 5.6. So formula, you must remember very well. So cost of equity, how to calculate? First is dividend divided by market price of the share into 100 plus growth rate. Dividend divided by market price of share into 100 plus growth rate. KE workout. KE means cost of capital workout 16%. Cost of preference share capital KP is 10%. They have given itself. Cost of debenture KD, cost of debt I into 1 minus 8 into 1.3. This is 5.6. So this should be taken existing. Your equity share capital is this. This is given here. Total source is 60 lakh. 10 lakh divided by 60 lakh is 0.17. 30 lakh divided by 60 lakh is 50%, 0.50. 20 lakh divided by 30 lakh is 0.70. Then your weights, what we calculated? 16%, 5.6 into 10. Multiply this. 0.7 into 16, 2.72. 0.50 into 5.6 is 2.8. 0.30 into 10, 3. Totally it works out 8.52. This is WACC. Therefore, WACC is 8.52%. This goes for existing. Then, new one, see that. Compute new WACC. If the company raises an addition capital of 10 lakh, this is addition, along with another addition 10 lakh by issuing 15% debenture, which results in an increase in the expected dividend of 15 per share, and growth rate is unchanged. But the market price of equity will fall to rupees 120 per share. This is important. So go here, new one. So this is a old one. New one, calculated capital 10 lakh. Additional capital. Calculation of cost of capital. D is given 15. Price of the share is 120. There is a market price. Growth rate 8 remains same. D divided by market price of the share into 100 plus G. 15 divided by 120 into 100 plus 8%. It works out 20.5. Cost of debenture. KD I into 1 minus T. Your KD is I is 15, 1 minus T is 0.7. 0.7 into 15 is 10.5%. Regarding the KP, preference share remains the same. Equity share hold on 10 lakh, 8% debenture 30 lakh, 10% preference share 20 lakh, new one 15% debenture 10 lakh. Totally it becomes 70 lakh. Now 10 lakh divided by 70 lakh is 0.143. 30 lakh divided by 70 lakh is 0.429. 20 lakh divided by 70 lakh, it comes to 0.286. 10 lakh divided by 70 lakh is 0.142. Cost of capital, what we calculated? This is 20.5. This is 5.6. It is 10%. This is 10.5. Multiply 0.143 into 20.5, 2.93. 0.429 into 5.6 is 2.40. 0.286 into 10 is 2.86. 0.142 into 10.5, 1.49. New WACC, weighted average cost of capital. New WACC is 9.68%. New one. So you have to do for existing also, you have to do for new also. So what's the procedure? First, we have to find out the weight. How to find out the weight? Add the figure, and for each individual, you have to calculate 10 lakh divided by 70 lakh, 30 lakh divided by 70 lakh, 20 lakh divided by 70 lakh, 10 lakh divided by 70 lakh, we get the weight. Then you have to calculate the cost of capital. How to find out the cost of capital for equity? Dividend divided by market price of the share into 100 plus growth rate. Regarding the preference, whatever be given, that should be taken. Regarding the debt is considered I into 1 minus t. 8 into 1 minus t, 15 into 1 minus t we have to do. Then multiply. Then whatever the total get, this is called weighted average cost of capital. So I will go by one. This is a problem they will give. Weights they will give. First weighted, this is 60 divided by 60, 10 lakh divided by 60 lakh, 30 lakh divided by 60 lakh, 20 lakh divided by 60 lakh. Then same thing, dividend divided by market price of the share into 100 plus growth rate. One you have to do for existing, one for the new. This is definitely come from the examination point of view for 15 marks. Hope you understand. I have done one for existing, one for new also. So how to find out? First find out the weight. Equity share capital divided by the total. Preference share capital divided by total. Debenture divided by the total. Cost of equity and the cost of capital have to find out. For equity, dividend divided by market price of the share into 100. Regarding the preference, whatever they given should be taken. Regarding the debenture is called I into 1 minus t. Multiplied weight into cost of capital. Whatever the answer gave, that is a weighted average cost of capital. Hope you understand. I have gone through very slowly. First you have to do for existing, then you have to do. This is a definite problem from the examination of point of view. We'll have some more problems on this in the next session. Till then, goodbye. Meet in the next session.